Hey everyone, I'm Emily Carter. Welcome back to US Stock Stories. Today we're talking about one of America's most iconic food companies, Tyson Foods, ticker symbol TSN. From the chicken on your dinner plate to the breakfast sausages in your freezer, Tyson is behind more brands than most people realize. But the real question is, as we head into 2026, is Tyson still a good long-term investment? Let's dive in. Tyson has long been seen as a defensive dividend-paying stock, the kind of company that stays steady when markets get bumpy. And that reputation isn't just talk. The company has raised its dividend for 13 consecutive years, offering investors a yield of around 3 to 4%. That makes it an appealing choice for anyone who values stability and consistent returns. Now, performance-wise, Tyson's showing a mixed picture in 2025. Revenue for the first 3 quarters topped $40 billion, a small but important 2% increase compared to last year. But what really stands out is profitability. Adjusted operating income jumped nearly 28%, showing that Tyson's cost-cutting measures and product mix improvements are finally working. Still, not every part of the business is shining. The beef segment, which has historically been Tyson's profit engine, is going through a tough cycle. A tight cattle supply and rising feed costs have squeezed margins, and management expects the division to actually post a loss for the year, somewhere between $375 and $475 million. That's a painful hit, but it doesn't define the whole company. Because elsewhere, things are looking much better. The chicken business is bouncing back thanks to better efficiency, and the prepared foods division, which includes household names like Jimmy Dean and Hillshire Farm, is seeing strong demand and healthy pricing power. Together, these two units now make up the bulk of Tyson's operating profit, giving the company a more balanced and resilient foundation than before. On the financial side, Tyson remains disciplined. It's generating solid cash flow, keeping debt under control, and continuing to reward shareholders with that reliable dividend. Yes, the company has faced some legal challenges over alleged price fixing, but those settlements seem manageable and shouldn't threaten its long-term outlook. Looking ahead, management is guiding for sales growth of about 2 to 3% for fiscal 2025. If cattle prices start to ease and inflation stays moderate, Tyson's profitability could see a meaningful rebound in 2026. So, here's how I see it. Tyson isn't the flashiest stock on the market. You won't see explosive growth here, but it's a solid, income-generating, defensive play. The short-term headwinds in beef production are real, but the company's strong brands, improving margins in chicken and prepared foods, and disciplined capital strategy give it a stable long-term footing. Investors who are looking for steady income and moderate growth might find Tyson a comfortable fit for a balanced portfolio. The key will be watching how quickly beef margins recover, how the company manages raw material costs, and whether it keeps up its tradition of raising the dividend each year. So, what's your take? Do you see Tyson as a buy and hold stock for the long haul, or do you prefer faster growing food names like Hormel or Beyond Meat? Let me know what you think in the comments. I'd love to hear your perspective. If you found this breakdown helpful, don't forget to like, subscribe, and hit that bell icon so you never miss a new stock story. Thanks for watching. I'm Emily Carter, and I'll see you in the next one.